Welcome to Nick's Investment Lab. My name is Nick, and today we're going to talk about the popular different types of investments, number 2. So first things first, I will point out, as just mentioned, this is the second edition. So if you are like, hey, Nick didn't talk about any stocks or bonds, that's because we talked about those in the first one. So I'm going to piggyback on some of those ideas, and we're going to start with some whole new ones as well. So to start things off, let's talk about high interest savings accounts. High interest savings accounts, or also known as high interest savings funds, are a lot like a GIC, but imagine more like the cashable GIC, but rather than having the tiered levels of earned interest rates, it's a flat interest rate that is calculated daily but paid out monthly. The nice thing for high interest savings accounts or funds is that you have daily liquidity. So if you need money, you can have access to it within 24 hours. Once again, 24 business hours. A few limitations there, but anyway, quickly accessible is the main feature. And another key feature is that there's no downside risk, at least in regards to volatility. The only real risk you have to worry about is the company failing, right? The one that's issuing it. And once again, CDIC coverage is offered per account up to $100,000. So not a major risk, but something that is worth mentioning. Why use a GIC over a high interest savings account if they both offer a level of guarantee as well as downside protection? The key thing is liquidity. So GICs are not as liquid and therefore offer a higher interest rate to compensate for the fact that your money is locked in. High interest savings accounts or high interest savings funds are generally going to be the lowest interest rate that you're going to be finding apart from your standard savings account or checking account. So it's not necessarily an appealing rate, but it's better than nothing. Another popular yet quirky type of investment is the preferred share. Now, preferred shares are kind of like a hybrid between fixed income and equity or stocks. And key reasons why is number 1, they have preferential treatment for dividends. So let's put it this way, if a preferred shareholder is not receiving dividends, the common shareholder, which most shareholders are definitely not receiving dividends. So they generally look at preferred shares as perpetually receiving dividends indefinitely. Now, with that being said, a drawback or a limitation of preferred shares is that they don't actually come with any voting rights. So there are certain risks with that, especially for those that want to maintain some level of control within the corporation. Real estate or real estate investment trusts, also known as REITs, these are pretty well exactly what they sound like, ownership in real estate. Now, I've heard from a lot of people that the best investment they ever made was in property or in land. So this is a great way to participate exactly in that. Some types of real estate are a little bit more straightforward in the sense where you're going to buy a rental property. So pretty straightforward. You buy the property, rather than living in it, you rent it out to somebody else and you collect rental income, but you deal with all the expenses that come up as well. Now, you may not want to have to buck up that kind of cash or have that level of risk or deal with tenants or a property management company. So you might want to elect to go with a real estate investment trust, which essentially gives you the perks of ownership in real estate, specifically the collection of rent or the appreciation of the value of the real estate over time, but without the drawbacks of actually having to deal with tenants, without having to deal with trying to sell it later, maintain the properties, so on and so forth. So real estate investment trusts are pretty cool in the sense that they sometimes have thematic ideas. So there's some that I've seen that are specifically for storage units. There are some that are specific to strip malls. So it really depends on what you're looking for. But what's cool about it is there's something for everybody. Commodities, things like gold, things like silver. Also, but not limited to, things like oil or grain. Now, generally speaking, if we're going to talk about investable commodities that your average person might have money in, we're probably not talking about wheat. Probably going to be talking about things like precious metals, but commodities are a very broad space. With that being said, sometimes you're going to have those people that come in and want to invest in physical gold. I want to own a bar of gold, which comes with its perks. Not everybody, but a lot of people like something flashy. But also being able to physically hold it, being able to know that it's real, being able to have that tangibility is worth something to some people. Major drawback of this I see is, number one, easy to get stolen. Number two is liquidity. So gold bar or whatever, maybe it gets turned into a chain or something. Once again, nice to have, but problematic in the sense that if I want to turn that to cash tomorrow, I have to find a buyer. If we're talking about large amounts of commodities, maybe something that's not as valuable, something that's not as pound per pound worth something, it might be worth not having to pay to store these items, especially for things that are a lot larger. So to avoid that, it has been a lot more popularized to utilize ETFs or mutual funds that track the price of select commodities. Once again, specifically gold and silver. Private equity. So private equity is an interesting one. Something that I'm sure we're all familiar with in the sense that not all businesses are owned by thousands of shareholders spread all across the world. Some businesses are owned by one or two people, mom and pop shops, and once again, sometimes by somewhere in between, where a variety of different shareholders. So with this being said, a couple of the merits of private equity is, number one, you don't have to deal with all of the volatility of the overall market. So what I mean by this is, if you watch the stock market, sure, no surprise to you, sometimes the prices of things go up and down. In fact, I promise you the prices of things go up and down every day, which is fine. This is normal. This is natural. This is the forces of supply and demand at play. But one of the limitations is that sometimes when politicians make big announcements or flap their gums for various reasons, the markets react. And sometimes you don't want to necessarily be caught up in that. So one of the major benefits of private equity is that valuations are generally based off of an actuary. So they have an independent party that comes in and values the company based off of a variety of metrics, specifically maybe the assets they hold, their current revenues, and future prospects for revenues and profitability. So why this is cool is you're actually having your company valued based off of metrics related to them, not based off of whatever Trump's talking about today. Sorry, I had to go there. But in any case, private equity definitely does have its perks in that regard, but it does have its drawbacks as well. Specifically, that it's not nearly as accessible as your common shares. You can't just go into any market and buy them. I do utilize some private equity and some market exempt securities for clients, and there is a lot of extra paperwork that is involved. Liquidity isn't necessarily next day as well, so there are a lot of drawbacks with it in that regard. Once again, like everything, the good and the bad. Segregated funds. I'm going to be real quick on these because I am not a fan of them, and once again, because I'm not a fan of them, I don't want to misrepresent them. But segregated funds are kind of a hybrid between mutual funds or ETFs and an insurance product. So they are actually considered an insurance contract. So when you purchase a segregated fund, you are purchasing, as I just said, insurance product. And with those, they often have guarantees. So for example, if you purchase into this fund and you put in $100,000, after 5 years, you may have an 80% guarantee where regardless of what the value of the fund is after those 5 years, you are guaranteed to get 80% of the value of what you put into it, which might sound great for somebody that's very risk adverse. What you might not necessarily see is that any portfolio that has even a reasonable degree of diversification should not be 20% down after 5 years. So once again, having that level of guarantee might be nice for somebody, but you probably don't need it. In fact, I'm here to tell you, I can almost say with absolute certainty, you do not need it. once again, I digress. With that being said, another major drawback that I see with segregated funds is the fact that their fees are quite atrociously high. And once again, what are you paying for? The guarantee that you don't need. On that note, I'm going to stop being a negative Nelly and move on to the last product now. And lastly, the one that I feel like every millennial and Gen Zer is familiar with, crypto. Now, crypto has made massive leaps and bounds over the last number of years, and I'm going to say it is probably one of the most widely traded assets, but probably one of the least understood. And that includes by me and many others who actively monitor the markets. So I know there's going to be people that are watching this that are like, Nick, you're an idiot. You don't know what's going on with crypto. And fair enough. I don't want to be the one to claim to be a crypto king by any stretch. But what I can say is prices are determined on supply and demand. Supply and demand of what? That I have yet to understand. But I also can say that it seems that things often move in semi-predictable cycles. So with that being said, there's a variety of different cryptocurrencies that exist. A couple of the big ones include Bitcoin and Ethereum. The best way to purchase into these historically has been through crypto wallets, something I am not well versed in, especially as somebody who works with a brokerage and a dealer. I don't have access to these. So my exposure to crypto is generally through ETFs and mutual funds. So generally this will, kind of like the commodities, give you the participation in the price of the cryptocurrency, but not have to deal with the added regulatory stuff, not actually having to deal with actually owning it, the ability to hold it in a tax-free savings account or an RRSP, for example, a few little added benefits there. So I think that what is really cool about crypto is that it is a space that is still quite new, despite the fact that it's been here about 10 years now, maybe even more, once again, playing to my naivety here. But I think that we are still in the early infancy stages of it and a lot more to come. Once again, I'm sure I missed a ton of things here, but hopefully that helps wrap off this list a little bit better. Once again, if you have any questions, any inquiries, please send them over to nixinvestmentlab@gmail.com. And of course, please like, comment, subscribe, and keep an eye out for future videos that we have. It could be popular investment types number 3.